Platinum just fractured into 4 prices at the same time, and the spread is telling you the real market isn't the one on your screen. The numbers flying around in clips, $980, $115, $140, $100, might be stale screenshots, mixed units, or people quoting different instruments as if they're the same thing. But the important part is that the phenomenon is real. In a stressed commodity, 1 ounce can have multiple clearing prices depending on where it is, what form it's in, and what rules it sits under. And that's exactly the kind of setup the mainstream tries to minimize, because if this is more than noise, then the next move isn't emotion, it's math. Here's the payoff you're going to get by the end. The one hidden signal that tells you whether this move has another leg in the next week or two, the 2 zones that matter most right now, and the simple checklist that keeps you from getting shaken out by a volatility ambush. The comforting story you're going to hear is that this is just messy quoting. 1 clean global price, a few bad prints, and it all snaps back. Now that story sounds reasonable, and it's how people talk when they want you calm. But calm is expensive in a tight metal, because arbitrage is not instant. Arbitrage is a shipping schedule, a financing line, a refinery queue, and a margin call risk, all at the same time. And when those frictions stack up, prices don't converge, they fragment. And that's where the real pressure starts. Let's lock in the basic verified context so we're not floating on vibes. In early January 2026, platinum has been trading around the low to mid $2,300 per ounce. And it has been swinging hard, pushing up toward the $2,400 area on strong days and snapping back toward the low $2,200 when liquidity thins. That kind of range tells you the market is reactive. It also tells you older reference thinking, the old 1,000 handle mentality, is psychologically dead, even if it keeps resurfacing in recycled screenshots. And late last year, plenty of institutional forecasts for 2026 were still anchored far below where the market has already traded this month. Not because analysts are foolish, because tightness can flip from slow to violent faster than models can update. But that's not the part that matters. The part that matters is what 4 prices actually means in plumbing terms, because once you see it, you can't unsee it. When people say 4 prices, don't picture a glitch. Picture 4 different clearing points for 4 different kinds of exposure. First is the benchmark style reference, what headlines call spot, often tied to London OTC conventions. Second is a standardized futures equivalent price, what trades on a big exchange with its own delivery rules. Third is an onshore domestic price, what clears inside a country that can keep inventory at home and where credit, taxes, and capital controls can change behavior. Fourth is the street-level physical premium, what a buyer actually pays for bars, coins, sponge, or industrial forms when supply is tight and dealers are protecting themselves. Those are not the same product, and in a stress regime, they stop pretending to be, because if one key level breaks, the math changes. Here's the hidden detail that reframes everything. The tightness shows up first in the cost of borrowing metal in the shape of the forward curve, not in the headline spot print. When platinum lease rates are elevated, meaning it's expensive to borrow physical metal for short periods, that is the market screaming that nearby availability is scarce. And when the forward curve is backwardated, meaning near-term delivery is priced above longer-dated delivery, that's not a cute curve shape. That is a rationing mechanism. It says possession now is worth more than promise later. Put it in plain money terms. If the annualized cost of borrowing metal is north of, say, 20% during a squeeze, that's on the order of roughly 5% to 2% per month. On a $2,300 ounce, you're talking about tens of dollars per ounce per month just to borrow and carry, before you even talk about shipping, assay, insurance, and margin. So when someone says, why doesn't arbitrage close a $30 or $50 gap? That's your answer. The market is charging a rent on time, and the rent is brutal. That's why I keep saying the headline price can lie for a day, but the spread is where the truth leaks out. And when that truth leaks out, big players start changing behavior, quietly at first, then all at once. Now, why is this flaring right now, today, this week, this month? The calendar compresses risk. Earlier risk budgets reset. Funds rebalance exposure. Liquidity comes back unevenly after holidays. And pockets of thin trading can make moves look exaggerated. At the same time, commodity markets never stop being governed by contract mechanics, roll decisions, delivery windows, and the way hedgers and speculators manage nearby risk. If you have tightness in the nearby months, time stops being neutral. It becomes expensive. And expensive time makes people rush, and rushing creates mistakes. Also watch the microcalendar, weekends, and thin overnight sessions. When liquidity thins, a relatively small order can move price far, and if news hits into that thin pocket, you can get gap risk. And in a market where multiple venues are already misaligned, gaps don't just move price, they move spreads. And that's when the market feels like it has 4 prices at once. Now widen the lens for a second, because platinum never moves in a vacuum. The macro backdrop matters, even for a metal that is half industrial and half monetary in the way people treat it. When the precious metals complex is catching bids, when gold is acting like a geopolitical barometer and silver is acting like a volatility amplifier, capital gets curious about the corners of the complex that are smaller and more levered to scarcity. Platinum is exactly that corner. It's not as liquid as gold. It doesn't have the same deep, continuous demand from central banks. But that's precisely why it can move faster when flows arrive. A relatively small amount of investment demand can overwhelm the marginal physical market, especially if that demand arrives at the same time as industrial procurement is still steady. And here's the trap. People wait for macro to be perfect. They wait for rates to cut. They wait for the dollar to roll over. They wait for the headline to confirm. Meanwhile, the metal trades the plumbing. It trades the availability. It trades the spread. And when it finally shows up in the headline, the easy part is already gone. That's why you have to watch the hidden gauges, not the loud noise. Also, macro can create sudden air pockets. A hot jobs number, a hawkish central bank tone, a risk-off shock, any of those can spike the dollar, hit commodities, and trigger margin calls. In a market that's already thin, that can slam platinum even if the physical tightness hasn't changed. That's why the volatility reminder is not a disclaimer. It's the core of the strategy. Price can whip around violently even if the thesis is correct. Treat the trend signal as the structure, tightness, backwardation, borrowing costs, persistent premiums, and treat the day-to-day swings as noise that can be weaponized against you. Because that's what the market does. It uses noise to force you to confuse discomfort with wrongness. Now back to supply chain, because this is where the tightness becomes stubborn. Platinum supply is concentrated and slow. Mines take years to expand. Maintenance, power constraints, labor issues, and geopolitical risk don't show up on your chart until they do. And when they do, the market doesn't get a gentle warning, it gets a gap. Recycling helps, but recycling is pro-cyclical in its own way. Scrap flows depend on incentives and timing, and when prices jump, scrap increases, but it doesn't increase instantly, and it still has to be processed. Refining and logistics are the hidden bottlenecks. Even if the metal exists somewhere in some form, converting it into deliverable or industrial-ready form takes time. And time is exactly what backwardation penalizes. This is also where byproduct dynamics matter. Some PGM output is tied to mining decisions that are not made for platinum alone. So supply response is not simply price up, supply up. And when supply can't respond quickly, the market relies on above-ground stocks to bridge the gap. That's why the conversation about ETFs and exchange stocks matters. If metal comes out of those pools, it can soften tightness temporarily. But if the market still shows high borrowing costs after those releases, that tells you the underlying deficit pressure hasn't been cured, only managed. And that is exactly how a market can look balanced on paper and still trade like a squeeze in the front end. Now here, it's the institutional behavior piece that doesn't get enough attention. Security of supply becomes a theme. When corporates and large traders fear policy shifts, tariffs, quotas, or investigations into critical mineral imports, they don't wait for certainty. They pre-position, they stock, they build buffer inventory. That behavior is rational, and it's also self-fulfilling, because the act of building buffers tightens the nearby market and increases the very premiums they were trying to avoid. That's reflexivity again, not emotion, math. And once buffer building starts, it doesn't stop because the headline says tariffs excluded. It slows only when the market believes the risk is truly off the table. And in geopolitics, risk is rarely off the table. One more proof layer. The way premiums react to policy tells you whether the market is still pricing in that risk. If premiums collapse and stay collapsed, fear is easing. If premiums keep reappearing on every new rumor, fear is alive. And if fear is alive while borrowing costs are elevated, the setup remains combustible. Because if this one level breaks, the math changes. Now let's take the plumbing apart, because this is where trust is built. Start with the benchmark reference. A reference price is useful for marking books, comparing days, and telling a story. But in stress, a reference can lag the real battle because it can reflect marginal paper transactions more than marginal physical transactions. Now look at futures. A futures price is not the price. It is a price for a contract with standardized terms, margin rules, and delivery procedures. And those procedures decide who can turn paper into metal, where that metal can come from, and what counts as acceptable delivery. In normal times, the bridge between futures and physical is smooth enough that people assume it's automatic. In stress, the bridge becomes a toll road. The toll shows up as a basis and a premium. This is exactly what we saw when trade policy and tariff fears distorted precious metals flows. When the market thinks supply could be dislocated, traders move metal toward the venue where delivery is valuable. They deliver into exchange warehouses. They stockpile where it can satisfy contract obligations. They don't do this because they woke up bullish. They do it because the basis pays them to do it. And when policy headlines change, those premiums can compress fast. That's the key insight. The premium isn't a decoration, it's an incentive signal. Incentive signals tell you where the market is stressed and who is being forced to move. Here's how the mechanical chain works, and this is what most people miss. Suppose platinum trades richer in New York than in London. In theory, you buy in the cheaper place, sell in the richer place, and pocket the spread. In practice, you have to source the right metal in the right form, finance it, ship it, insure it, vault it, clear it, and manage the risk of that spread moving against you while you're in transit. That transit is time. Time has a cost. If lease rates are high and the curve is backwardated, carrying metal is punitive. So arbitrage becomes slower and more selective, and the gap can persist long enough to look like multiple prices. Not because the market is broken, because the market is rationing access. Now add the China layer, and the story gets sharper. China is not just a consumer of metals, it's an organizer of supply chains. When China develops more meaningful onshore derivatives for platinum, like the launch of platinum and palladium contracts on the Guangzhou Futures Exchange in late 2025, it isn't OIT, just another market. It's another inventory magnet. It gives domestic industry and traders a way to hedge onshore, and that supports onshore stockholding. And if the onshore system is paying a premium, metal can be pulled into that system and stay there longer because the hedging tool exists locally. That's why a domestic price can diverge, especially when global logistics are strained. Now, the street-level physical market. When the paper market says one thing and physical premiums say another, you're looking at the difference between exposure and availability. A premium rises because supply is tight, because fabrication capacity is constrained, because distributors are cautious, or because they're protecting themselves against volatility. In a tight regime, the premium isn't just profit, it's a shock absorber. And when certain forms, like sponge used in industry, carry their own premium behavior, that's another way the market admits that platinum is not a single product. It's a family of products. Now zoom in on the most misunderstood choke point, deliverable inventory versus total inventory. Reports can say above ground stocks exist, and that can be true, yet the market can still be tight, because not all stocks are accessible, not all stocks are in the right place, not all stocks are in the right form. Some are strategic, some are financed and locked, some are simply not for sale at the current price. And if the deliverable pool is thin, the nearby market gets tight, even if the annual supply-demand balance looks close on paper. That's how you can hear talk of a more balanced market in 2026 and still see the market scream tightness through borrowing costs and backwardation. The mainstream looks at annual totals. The market trades the next shipment. Now stack proof, because in a market like this, you never trust a single argument. Proof point one is price behavior itself. Platinum has shown explosive movement over the past year and violent ranges this month, which is typical of a market where liquidity is thin and positioning is sensitive. Proof point two is the tightening signal from lease rates and the forward curve. Persistent elevation in borrowing costs and backwardation are classic signs of nearby scarcity. Proof point three is geographic dislocation, when spreads between venues expand and compress around trade policy expectations and warehouse flows. That's the market repricing logistics and deliverability. Proof point four is institutional stock movement. Shifts in ETF holdings and exchange stocks can inject metal temporarily, yet tightness can remain if the right metal is still hard to source at the margin. Proof point five is onshore market structure. New domestic contracts increase the ability to hedge and stock metal locally, which can support persistent regional premiums. And here's a sixth that people forget: options positioning. When a market has a lot of call exposure near current price, dealers who sold those calls often hedge by buying as price rises. That's delta hedging. If the market runs into a zone where gamma is high, those hedges can become reflexive. Price up forces dealers to buy more, which pushes price up again. It doesn't require a conspiracy. It's a mechanical feedback loop. And in a thin market, even a modest gamma effect can feel like a stampede. Now, who gets squeezed by these mechanics? Start with the industrial buyer. An industrial buyer doesn't care about your chart. They care about continuity. If they fear disruption, they pay up. Paying up tightens the nearby market, which supports backwardation. Now look at the bank or trading house that finances inventory and lends metal. If lease rates rise, their carrying cost rises. Their risk manager tightens limits. They demand more collateral. They reduce willingness to warehouse metal for thin returns. That reduces liquidity. Now look at the futures short. If the market is rising and volatility is high, margin calls can force covering. Covering is buying. And in a thin market, forced buying is a rocket engine. That's the reflexive loop. The market moves, which forces flows, which makes the market move more. Now we have to talk about your emotions, because this is where most viewers lose. In a tight metal, volatility is not proof the thesis is wrong. Volatility is the tax you pay for being early, and the weapon the market uses to transfer your position to someone with stronger funding. The market will try to manipulate you with 3 tricks. Trick 1 is the headline slap. A scary macro story hits, price drops fast, and you decide the whole setup is dead. Then the market rebounds, and you sold into the hole. Trick 2 is the breakout bait. Price surges through a level in thin liquidity. The crowd screams new era, you chase, and then it mean reverts, and you panic sell. Trick 3 is the slow bleed, a grind lower that feels like punishment, designed to make you abandon the position right before the next leg. You beat these tricks with a framework: trend signal versus noise, levels that matter, and position sizing that survives. Because the market doesn't care if you're right. It cares if you can stay solvent. So let's get specific without pretending we can forecast to the dollar. There are 2 price zones that matter right now because the market has already shown you it reacts there. Zone 1 is the low $2,200 area. Platinum has treated that region like a referendum in recent sessions, touching it, bouncing, and using it as a pivot. If that zone holds on pullbacks, it suggests demand is absorbing supply and the tightness narrative remains intact. Zone 2 is the upper range into the $2,350 to $2,400 neighborhood. That's where momentum can stretch, where sellers are tempted, where the tape has already shown rejection and reattack behavior. If price can hold above that zone after a push, it's a sign the market is willing to reprice again. If it repeatedly fails there and at the same time borrowing costs cool and the curve relaxes, it suggests the accelerant is easing. Now, the honest counterpoint. Some forecasts and analyses have pointed to the possibility of a more balanced platinum market in 2026, even a modest surplus, driven by changes in investment demand, improved recycling, and shifts in mining output. That is a real possibility on an annual ledger. But an annual surplus does not automatically rebuild the buffers that matter. If above-ground stocks have been drawn down to cover deficits, you can have an unbalanced year and still have a market that feels tight at the margin. And in tight metals, price has to do 2 jobs: ration demand and pull out reluctant supply. If it fails at either job, the market keeps pressing. Okay, so what happens next? Over the next 1 to 2 weeks, the market will likely force a choice between 2 scenarios, and you can watch the decision being made in real time. Scenario 1 is the controlled pullback and retest. Price cools off from the upper range, tests the pivot zone around the low 2200s or nearby support bands, and volatility stays high but contained. The tape looks scary, but the structural tightness signals remain stubborn. Borrowing costs do not collapse. Backwardation does not vanish. Physical premiums do not suddenly normalize, and regional dislocations do not magically disappear. This is the scenario where patience and risk management matter most, because the market's job is to make the retest feel like failure. And if that support holds, the market often rebuilds a base that can launch the next leg. Scenario 2 is the continuation squeeze and gap risk. The market does not give you the clean retest. It holds above pivots, liquidity thins, and price accelerates. This is where short covering hedging flows and physical restocking can stack. This is where overnight moves feel larger because there are fewer resting orders. And this is where the multiple prices story can get louder, because fragmentation widens when the market is moving too fast for logistics and arbitrage to keep up. The confirmation for scenario 2 is not just higher price. It's tightness staying hot while price climbs, backwardation firm, borrowing costs elevated, and premiums refusing to relax. Here's your invalidation logic, because every thesis needs a way to be wrong. If platinum breaks down through the pivot zone and cannot reclaim it, and at the same time the tightness indicators cool meaningfully, borrowing costs fall, backwardation relaxes, and regional premiums compress in a way that suggests metal is easier to source. Then the near-term squeeze thesis weakens. That doesn't mean platinum becomes a guaranteed bear market. It means the accelerant is fading, and you should expect a different kind of price action. On the other hand, if price chops and whips but the tightness signals remain elevated, that tells you the pullback is more likely a positioning reset than a fundamental release. Now the checklist you can use starting today. Watch the gap behavior between major venues as a proxy for geography stress. Does the premium that matters to big players expand or compress? And does it do so around policy headlines and warehouse flow commentary? Watch basis and exchange for physical style pricing as a proxy for how costly it is to bridge paper exposure and physical reality. Watch credible signals about ETF holdings and exchange stocks, not as a holy number, but as a direction of flow story. Is metal being coaxed out or hoarded back in? Watch onshore behavior in China, because a market that can hedge domestically can choose to keep inventory domestically, and that can support persistent regional premiums. Watch the curve, because if the curve stays tight, the nearby market is still stressed. And watch the tape at those 2 zones, because that's where psychology and mechanics collide. And don't jump from spreads to cartoon villains. You don't need that. Incentives explain it. Risk management explains it. Market structure explains it. When metal is scarce nearby, anyone who can control inventory has leverage. When borrowing costs rise, anyone funding inventory tightens terms. When futures premiums appear, anyone who can move metal earns the spread until the spread disappears. This isn't a morality play, it's a pressure system. And pressure systems release energy in bursts. If you're the kind of person who wants to track the curve, the spreads, the inventory signals, and the calendar triggers, not just chase candles, then you're already in the minority that survives these regimes. Stay with that minority. Compare frameworks. Keep score with mechanisms, not feelings. And here is the part almost nobody plans for. The market will try to timestamp your emotions. It will drop the most convincing bearish headline right at the moment liquidity is thinnest, then rip when you're numb. It will rally into a level that looks obvious, then slam it just enough to make you doubt, then continue without you. So build your rules now while you're calm. Decide what you're watching and what you're ignoring. If you're tracking this like a pro, you don't just stare at the candle. You watch the term structure. You watch the cost of carry. You watch whether the nearby premium is getting paid again and again. And you watch the calendar like it's a catalyst. Because roll periods, delivery windows, and thin liquidity sessions are when the market reveals its real constraints. Over the next week, if you see price pull back but the curve stays tight, that's information. If you see price push higher and premiums widen, that's information. If you see the opposite, premiums collapse, borrowing costs cool, curve relaxes, that's also information, and it changes the play. And if you're the kind of person who wants that kind of framework-driven coverage, mechanisms first, noise last, stick around this corner of the internet where we track the pressure gauges together. Final point, and this is the metric I want burned into your mind. Watch whether tightness stays elevated even when price pulls back. If borrowing costs and backwardation remain stubborn while price dips, the market is telling you the metal is still hard to source nearby. And the dip is more likely a positioning reset than a fundamental release. If tightness breaks down alongside price, that's when you adjust expectations. Because in a tight platinum market, the headline price can lie for a day. The spread can't. And once the spread starts talking, the market can't unsee it.